In this video, I'll be breaking down how much you need to make in order to afford the brand new 2023 Dodge Hornet. I think you should really consider following one of these rules in order to avoid making a huge mistake, financially speaking, that'll end up setting you back for years to come. I've also got a link to a free auto quote down there in the description where you could save up to about $600 a year on your own insurance. It's completely free to fill out, takes like 20 seconds, but more on that later. There are 4 options I'll be going over today, and you can decide on which one suits you the best depending on how into cars you are. Some people out there just want something cheap, take them from point A to point B reliably, and some are willing to sacrifice quite a lot more, spend a lot more money in order to get the car that they really want to. Stick around to the end of the video to find out what method would be best for your personal preferences and situation. This is 4-Wheel Finance, a channel dedicated to helping you make smart financial and car buying decisions. Before I dive into this first rule, these videos take quite a lot of time and effort to make, so please give it a like, subscribe, comment down below what other vehicles that you would like to see. The first rule is the 24-10 rule, and this states that you must put at least 20% down on the car, you should not finance it for more than 4 years or 48 months, and the payment can't be more than 10% of your monthly gross income. The 2023 Dodge Hornet has an estimated MSRP of right around $30,000. This would mean you need to put down $6,000. And with the average new vehicle interest rate, 3.86%, and a 48-month term, this would make your monthly payment $540.40. You're also going to be paying about $2,000 in interest here. Bank rate states that the average monthly insurance cost is $148 a month, but this varies quite a lot from person to person. It really depends on your age, your gender, your driving habits, your driving history, what part of the country you live in, etc. So use that smart financial link I've got down there in the description. It's completely free and it takes like 20 or 30 seconds to fill out an auto insurance quote. You could save up to $600 a year. This would bring your monthly total to $648.40. Going back to that 24-10 rule, this would mean you would need a monthly gross income of $6,484, which would be about $77,800 annually. I really encourage you to take a look at the opportunity cost here. If you were to buy a cheaper $10,000 car or $5,000 car in cash and put what would be your car payment of $540.40 in the market instead, over the course of 5 years with a relatively conservative 6% rate of return, this would turn into about $37,732, gaining over $5,000 in interest. Take a look at those Acorns and M1 Finance links I've got down there in the description below. Super easy to get started investing, and I really encourage you to get started as early as you can, even if it's a small amount of money. And this is just for the first 5 years. If you were to continue that for 10 years, it would amount to $88,228, again just at that 6% rate of return. And for reference, the stock market averages around 10% return per year, so this is pretty dang conservative. And the next rule is my own. I've come up with this myself, and I think you should have at least a 6-month emergency fund. Need to invest 15% of your monthly gross income into your 401k and max out your Roth IRA and ideally your HSA as well if you have one. And I know that this seems like quite a lot of saving and investing, but beyond that, I don't give you a monthly percentage rule that you have to stick to in terms of spending. So it's up to you to decide if you want to spend more of your monthly income on a vehicle or if you'd like to go out to eat more, go on more vacations, etc., things like that. And the 6-month emergency fund just ensures that you're covered in the case that anything crazy happens, like a car wreck or anything obviously like an emergency. And especially I want to hit on that 6-month emergency fund, especially for those of you that work in an industry such as sales or a commission-based industry, because your income might not always be secure on a month-to-month basis. And the investment portion just gives you a little bit of financial security later in life, probably when you're going to need it the most. A lot of people say that nothing's guaranteed, you should live your life how you want to now. And it's true that nothing's guaranteed, but it's difficult putting a value on having peace of mind for yourself or your family's future. The average American lives to about 78 years old, and your future self is going to thank you if you get started now. Next rule I'll be going over is the Dave Ramsey rule. He thinks you should have at least a 3 to 6 month emergency fund. The vehicle shouldn't be more than 50% of your gross annual income, and you should purchase it in cash. Given that the 2023 Dodge Hornet starts at around $30,000, this would mean you need an annual gross income of about $60,000. Ideally, it's nice to buy a vehicle in cash, as you would avoid having to pay that $2,000 in interest, and your insurance would be a little bit lower. But not everybody has $30,000 in cash that they can put towards a car, and there's a good chance that they could make more money if that was in the market instead. Final rule I'll be going over is the 1/10 rule, which is developed by a financial samurai. Personally, this is a rule that I think that the vast majority of people trying to build their wealth rapidly should consider. It really doesn't allow you to purchase a new vehicle, but it's set up to help you spend responsibly, which reduces your financial car ownership stress and increases your net worth a lot quicker over time. This rule is pretty straightforward. It states that you shouldn't spend more than 10% of your gross annual income on a vehicle. It can be new or old, but obviously for the vast majority of people, it's probably going to be used, and you should purchase that vehicle for at least 5 years, but ideally more. And the theory behind this here is to help minimize your financial stress, frees up a little bit of money to invest in assets or opportunities that come your way, things that are going to go up in value, not down in value like a car. It's much more stressful and difficult making life decisions when you're worried about payments each and every month. Once again, this is 4 Wheel Finance. If you've got any questions regarding car buying or how much of a car that you can afford, please leave them down there in the comments below. And don't forget to give a look at that Smart Financial link. That's a free auto insurance quote. It takes like 20 or 30 seconds to fill out, and it can save up to about $600